Jamie Dimon has led JPMorganchase for nearly 2 decades, delivering a total return of over 560% since becoming CEO in 2005. But that era may soon be over. At the latest Investor Day, the spotlight wasn't just on performance, it was on succession. Three internal contenders are emerging. Marianne Lake, the strategic CEO of Consumer and Community Banking, Troy Rohrbar, the approachable co-CEO of the investment bank, and Douglas Badnow, the veteran with 35 years at the firm. The leadership may change, but what does it mean for JP Morgan's future and its valuation? Let's find out. Welcome to another video. My name is Robin, and as per usual, I am joined by Kirill. And today we're going to discuss a stock that is close to Kirill's heart, namely JP Morgan. But before we dive in, we'll guide you through our valuation process, which will be what's in the news, the company fundamentals, and finally the value that you're going to get out of this video, the valuation of JP Morgan. And of course, guys, not financial advice. Kirill. Please take it away.
Business as usual, yes. As Robin mentioned in the introduction, some big, to be honest, a little bit shocking news, but I mean, to be honest, inevitable. Similar to Warren Buffett, also Jamie Dimon is thinking about stepping down. He's looking for a successor as a new CEO of JP Morgan. It's, to be honest, is a little bit surprising to me to also think about it because he really reformed JP Morgan from what it was. He most importantly delivered more than 500% of shareholder value in terms of returns. The stock was, when he just started, you can see it on the graph over here, and then to what kind of it really skyrocketed, especially in the past couple of years. So to be honest, it's really good for us, I think, to actually discuss the JP Morgan in our valuation part of things, of course, but also it's probably a little bit of a question mark. Would he be able to find a good successor? Would it be enough time for the proper transition so that, the rails that Jamie Dimon put JP Morgan on would, continue be as strong and powerful as it is and as it was in his tenure? So We're gonna dive into the financials over the past years. We're gonna look into the valuation, and of course, most importantly, we need to check: is the price justified? Could be overvalued, could be undervalued, and is it a good and interesting company to look at? So let's get into it, shall we?
Yeah. Of course. Of course, starting at our 930 web app, you can scroll down, Kirill, and then we have the nice overview of what the company entails. So what we see already some yearly dividends. We can see some 2.1% dividend yield. A 13 PE. Is it 13 PE? Do I read it correctly, or is it?
Yeah,
13
it's
PE. So that's quite cheap. It looks like I'm not sure what the PE is of the banking sector in general, but we can compare in a bit.
It's
But
usually quite low in general.
Yeah.
I would say on average it's pretty much can be lower tens. Rarely, I think at some point JP Morgan was around 30, but I think it's not there anymore.
Okay. But yeah,
But it's quite
some
normal.
some good gross margins, more than 20%, and some good operating margins, more than 26%. And if we look at the company foundation screw, if you scroll down a bit, we can also see a lot of green check marks. So we see that they have good revenue growth. Their net income growth has been growing a lot. Their free cash flow has not been growing as much. We also need to check where the problem lies in this case. So, guys, also for your information, these fundamentals are now based on our maximum time frame. So these might be a bit off. So we'll go into more depth and see why, for example, why the free cash flow growth is minus 200%. It might be something that happened in the past. It might be something recent. We'll check it out. Also, the same with their long-term debt-free cash flow coverage. We will need to look into that. But on the other side, they have been buying back shares and also growing the dividend. And that's, of course, really good news for you, for the shareholder, because this way they can return value back to you as a shareholder. So good things are bound to come. Kirill, do you have anything else, or can we go into the financial results?
I just want to say one thing. So it's when it gets to banking valuation, it's completely different from any other company out there. So we are usually covering, let's say, the fintech. For example, it was Visa, where we're also talking about American Express, talking about some tech companies, right? So they follow better under the traditional valuation formulas and assumptions, let's say. With banks, it's especially quite different. So, for example, if when Robin was a little bit doubtful in terms of the long-term debt coverage by free cash flow, it also very much could be just by the default nature of investment banking, because they have to create a lot of, especially short-term debt, just to keep on reinvesting, keep on moving assets around. So this could be potentially pretty normal thing. But what just want to say, like, as even a bigger disclaimer, that first, of course, not financial advice, but second of all, it's way more different from your regular company that you can evaluate yourself. So also keep that in mind. If you are more or less knowledgeable within the industry, you understand how it works, sure, maybe even some of that stuff what we're going to be talking about may not be applicable. But for the beginners, I would say please first make sure you probably do even better and bigger due diligence than you would usually do. Now I think we can move on.
All right.
Yes.
Good point. Curious, anything that you can see that catch your eyes? I mean, we just see some regular things, revenue growing incrementally, everything following that as well. Selling and general expense are correlated with those figures, so nothing too major.
I think at least what is good to see that a very stable pre-tax income, more or less revenue growth is, well, it has been plateaued over the past from, let's say, 2010 up until 2019, and then it kind of surged quite significantly. Could be different reasons for that. Let's say we know all of this stuff related to the economy, worries. We had COVID with lowering interest rates, so it could be many different things. I think what's a little bit sad to see that selling and general expenses are still more or less rising, which is something for you guys to be maybe a little bit careful about, which it's also quite a big portion. So let's say if we're talking about the revenue of almost 300 billion, selling and general expenses of 90 billion, it's already quite significant. We're gonna also check it in the ratios as well, and you can also see that the liabilities are constantly growing, especially including the long-term debt, especially over the past 2 years. So also keep that in mind. Does that make sense that JPMorgan is in trouble? Yeah, probably not, because they again loaded up on rather cheaper debt over the past couple of years, so it's rather easy to pay it down. But you also have to keep in mind that you need to have a good free cash flow growth and have quite enough cash in the bank. So be careful. Just keep an eye on that. Maybe also check, let's say, the debt obligations in more details when their maturity is and stuff like that later on. But we're not gonna look into that because we also don't really have too much time. Ratios.
Yeah, so for the selling and general expense, as you mentioned already, it's quite high. So it's getting better, honestly.
It does. Yeah.
Well, we'd like it to see it better near the. Yeah, it's okay, but it. Yeah.
To be honest, the lower the better, especially
Exactly.
let's say for an investment bank. I mean, come on, like what kind of sales that you gotta do? Okay, you also offer credit cards, you also offer debit cards with Chase. I get it. Maybe there you have way more competition, especially with all of these fintechs. So you have to really keep up. But it's good. It's good sign to see that it's slowing percentage-wise as a ratio, but the actual value itself is still keep on rising. So be careful. be careful on that. Yeah, and I think what Robin also said with regard to the free cash flow growth and the revenue growth and stuff, it's also a little bit volatile here and there. Sometimes you can see some crazy numbers of growth of, let's say, 50%, and then quite a few years of really big stagnation and negative numbers. So, of course, that would also result in similar troubles for the free cash flow. But it's a bank. I mean, again, this is something also that is really depending on the economic environment as well. So if economy is doing good, then the banks are also probably going to be doing well. So similar with JPMorgan and here. So I think, again, in this case, the biggest and the most important part, at least for the stock owner, is to make sure that, for example, there's still a dividend and it's increasing, and then there are share buybacks. So then at least the appreciation of your stock price would be boosted by these two factors, which is also the case that's happening at JPMorgan. So I would say it's not the best, not the sun is shining everywhere metrics wise, but it's also mainly because of the specificity of the banking sector, I would say.
Exactly. And I think that's also why our app is really great, right? Is you can just quickly start developing some patterns that you normally see. And then if they deviate from the path that you normally take, or they deviate from the graphs that you normally see, then it's good for you to really dig into and see the financials, especially if, for example, the valuation might be on the good side. So let's continue. So we can check the shares outstanding change. So buying back constantly, growing dividend consistently. So good to see there. The net margins are not as great as, I mean, they're above 20%. So that is really good. Not really sure why the colors don't match up, but this is really good to see actually.
Yeah.
And then
True.
And then also for the operating profit margin, really good. So these numbers are really good to see. Besides the other, things that you need to check on your own in their financial statements. Well, Kirill, I think there's only one thing left.
Yeah, we can do the exercise of evaluation. I think it's important at least to try to have a look into it and try to play around with assumptions a little bit, which might get tricky. Might really get tricky. And then also in the meantime, maybe Robin, you can pop up the Yahoo Finance or any other analyst estimates for the upcoming years. But basically, yeah, if you've seen our videos, you probably know how it all works. I'll try to be brief. So free cash flow starting point probably makes sense to take the last year, which is 79 billion. Quite nice. Could be better. Always could be better. Projection period. That is also something what we discussed about the news. So if Jamie Dimon is stepping down, there could be more uncertainties, right? So similar to the situation with Berkshire. Who is going to be the new CEO? How are they going to lead the company? How well, performance-wise, it would be quite hard to tell. On the other hand, you can say that is it possible that the company is going to get out of business in 2 years? Yeah, I don't think so. I would be really comfortable to still keep it with the 15 years projection period, 10 years. That's completely fine.
Yeah, and then we also need to put in that Jamie Dimon is still going to be there for at least 5 years. So there's no rush. He already announced the change of leadership just so that he can give them a tutorial on how he built things. I don't think it's bad to have a change in leadership, especially if it's handled like this. So if the handover is really great, then I think that's just a good thing overall. And also the candidates are really good. So I mean, there's nothing there to worry about. So I think let's put it up a bit. Like you said, 10, 15 years is quite doable, honestly.
Yeah. And I think if you also said that all the candidates are internal, right?
Exactly. So one is from the investment banking side. One is the CEO of the consumer part of things, if I'm right. Just let me double check. Yeah, so Marianne Lake is the CEO of Consumer and Community Banking. Troy Rorbra is co-CEO of the investment bank, and then Douglas Petno has been in the firm for 35 years, and they're also in JP Morgan. So that's, I mean, they know the business. It's quite good actually.
Yeah, indeed. So then let's say all of them are familiar with the business for quite a long time, and then plus in combination, as you said, there's going to be enough time to bring them up to speed, right? To just continue sharing the same vision and strategy that Jamie Dimon was keep on bringing up for all these years. Should be fine. But then again, there's still risks everywhere.
Exactly.
And uncertainties.
Yeah. So discount rate we put at 10% per usual. Of course, feel free to tinker around with this. But yeah, for the estimated growth rate, so we see that it has been growing quite significantly, 9%, 9% in the past 3 years, 24%. Do you want to know what the analysts say?
I'm curious. Yeah, just tell me. I don't want to say anything. Tell me.
So they're saying that they're gonna grow with 5% next year, which is quite one of the first times they have quite a conservative estimate.
Yeah.
Every time we check these things, it's like crazy high. But
surprisingly, I think this is one of these rare times when I would actually agree, because the interest rates are still high, and the Fed, our lovely Fed of the United States, still doesn't really want to budge because they're still trying to tackle the inflation. So the likelihood of the interest rates to go down significantly this year, unlikely, and we're already halfway through, pretty much through the year. So I would say it's actually okay to put 5%.
Yeah. I agree.
Surprisingly on the same page.
The projected PE ratio, 11%. That seems quite reasonable.
Yeah.
If I'm looking at what they're thinking, they are hovering around 17. So I think that's quite high, though.
Yeah, we can probably.
Yeah, I mean, if we are considering, of course, that we are projecting this for 10 years. Mm-hmm. So I would say let's just put it at 12. Have it stable. I mean, can you check real quick if we change the assumptions?
Yeah. Yeah. I think it's only for the maximum. It went up to 37.
Yeah. So I think exactly. So just keep it at 12. It's a good middle number. I think that's decent. It's reasonable.
Yeah. Yeah.
And then required rate of return. Of course, it depends on you, the viewer, or you, Kirill, or myself, how much money you want to get out of the investment. Normally, we put in around 10 or 11%, because normally if you buy an ETF, you would expect around 7 to 10% returns year on year. So because you're stock picking, you want to have a bit more, a bit more gains for the risk that you're taking. And then for the margin of safety, Kirill, I think for you, because you're already share owner, you have quite some knowledge of the industry and of the business. For Kirill, it might be very little, as maybe 10 or 0%. For me, myself, I'm not really into banking yet. So for me, it would be higher, but it depends on you, the viewer, how much risk you want to take, how much you know about the industry. And also you can just check what the margin of safety is for it to be over or undervalued as an exercise, let's say, to see what would happen, or at least how much risk you would be taking on for it to be undervalued or overvalued. And that's just a great way to check your sanity. And then you can click the analyze button, Kirill, and we'll see what pops out. Or at least for the margin of safety first, let's do 20%. Yeah. Let's do it right in the middle.
Let's start. Yeah, and then we can just talk it over later. Yeah, hit the analyze button, the magic button. Oh, surprising. Actually, it's quite
decent though.
Yeah. And even for the target, no, let's put it like that. First of all, the discounted cash flow formula, given our rather realistic assumptions for the growth, I'll just again come back to the revenue growth rates. So it's below the 20-year average. So even given that, it's almost undervalued, let's say, on the DCF formula, which is a good sign. The Warren Buffett formula, pretty much on par with the current price. The target valuation is, again, because we still put a rather long period of time, it gives rather a high number on that price. So to be honest, I would also say I'm pretty happy with this number. So around around $250 per share is a target, is an average valuation, and with a margin of safety of 20%, we're talking about $200 per share, let's say. So to be honest, rather realistic, and it's also not that far from the current price. So
exactly. And this is a good exercise, of course. We are constantly trying to update our sheet as well. So maybe in the future, we will see some things where we can easily remove the outliers. But in this case, like you said, Kirill, the outliers aren't that far off from what we're seeing. And the averages are quite good. And then the question is, for example, here, how much risk are you willing to take? So, for example, if you have a margin of safety of 20%, you wouldn't per se buy the stock unless you would be thinking of giving a premium to owning JP Morgan at the stage where it is in. That is, of course, also not pricing in the huge uncertainty you will have with the new leadership.
Yeah.
But that aside, Kirill, where can we get this magical web app?
I think I got the answer. I really got the answer. So, guys, you go to 930.com. The link would be in the description. And you can get it. You can either just go view a demo platform. No sign up, no nothing. You can just play around, have a look. That's it. You can also try for free. Also simple. You can just try a couple of companies, just do some valuation here and there. If you would like to also get some additional cool things, for example, getting a watch list with all your assumptions and with all your average valuations and stuff, you can get it as well. If you would like to get our new feature, a screener, where you can make a short list of the companies that might be interesting for you, either with a 930 score or with the market cap or some other metrics, you can also do that. So you can go to 930.com, you can choose your plan. Starter only offers the valuation part, and at the advanced package you get everything, including all the upcoming updates, whatever you want, whatever you need, only €3 per month. We are trying to make it easy to invest, to do value investing. We're trying to make it accessible, so that's why we're not putting some crazy money on this, so that you, an average Joe, even like with availability of $100, euros in the bank, and you would like to start investing, you can already gain advantage of not only blindly just following some investment bankers and them telling you what to invest in, but you can actually take an advantage and do it yourself. So 930.com, have a look. You can get it right now.
And with that said, Kirill, thank you for your insights. Thank you for watching, and we'll see you guys in the next video. Oh, one more thing before we go. We also have a Spotify. We forgot to mention this for 2 episodes already. But if you are wanting to watch these videos, or if you want to have some people screaming in your ear while you are driving on the highway, and you still want to hear something about value investing, then make sure to look on Spotify for 930 Finance, and you will find our podcast. It's the same style, it's the same videos, the same content, but it's for you, it's for on the go, so that we make it accessible, right? Anywhere, everywhere. And then you can check out 930.com. All right.
Fully agree.
See you guys. Have a good one.